Welcome to the lecture on partnership accounting. In this lecture, we will discuss about different types of profit sharing ratios, such as old ratio, new ratio, sacrifice ratio, gain ratio, and methods of valuation of goodwill. This includes average profit method, super profit method, annuity method, and capitalization of super profit method. In partnership firm, the profit sharing ratio between partners changes due to reconstitution. There are five situations under reconstitution: change in existing profit sharing ratio, at the time of admission of a new partner, retirement of a partner, death of a partner, and at the time of dissolution. Reconstitution means change in any of the conditions of partnership firm. It may be due to change in existing relation among partners, that is, change in profit sharing ratio. It may be due to admission of a new partner, retirement of old partner, or death of any partner, and at the time of dissolution of a business. Let's take each situation in detail. First point, change in existing profit sharing ratio. For example, if A, B, C are equal partners, that is, the profit sharing ratio is 1 is to 1 is to 1. If there is change in existing profit sharing ratio, it means this is the old ratio and new ratio is 2 is to 1 is to 1. Then it is a case of reconstitution. The existing profit sharing ratio is changed now. So old ratio was equal 1 is to 1 is to 1, and new ratio is 2 is to 1 is to 1. In case of admission of a new partner, for example, profit sharing ratio among A and B is equal 1 is to 1. This is the old ratio. It means if there is a profit of 30,000 rupees, it will be distributed among A and B by 15,000 and 15,000 each. If Mr. C is admitted as a new partner, it means if new partners are A, B, and C is also an equal partner, so new partners will be A, B, and C. A and B are old partners. While admitting Mr. C as the new partner, he will be called as incoming partner. Here, Mr. C is an incoming partner and new partners are A, B and C. Old partners A and B, incoming partners Mr. C, new partners will be A, B and C. Here we have assumed that Mr. C is also an equal partner. In this case, new ratio will be 1 is to 1 is to 1. And now this 30,000 will be distributed among each partners. 10,000 rupees, 10,000 rupees, 10,000 rupees. So old ratio was 1 is to 1 among A and B. In case of 30,000 rupees of profit, it was distributed among A and B by 15,000 rupees each. Now Mr. C is admitted as an incoming partner and C is also an equal partner. So these 30,000 will be distributed among each partners equally. That is 10,000, 10,000, 10,000. And this 10,000 rupees of Mr. C has been sacrificed by Mr. A and B equally. It means the profit of 5,000 rupees is sacrificed by Mr. A and Mr. B. Now they are getting 10,000 rupees only. So the profit is now reduced by 5,000 each. So there will be new term is sacrifice ratio. So sacrifice ratio is also equal because Mr. A and B has sacrificed equally after admitting Mr. C. So Mr. A and B both equal partners. In case of 30,000 rupees of profit, they were sharing 15,000 rupees each. So old ratio was 1 is to 1. At the time of admitting Mr. C as incoming partner, new partners will be Mr. A, B and C. So new ratio will be 1 is to 1 is to 1 because Mr. C is an equal partner. So these 30,000 rupees will be distributed among each partners equally. That is, the new ratio will be 1 is to 1 is to 1. These 30,000 will be distributed as 10,000 for each partners. And now profit of old partners has been reduced by 5,000 rupees. So sacrifice ratio will be equal. Sacrifice ratio formula is sacrifice ratio equals to old ratio minus new ratio. Sacrifice ratio equals to old ratio minus new ratio. In case of admission of a new partner, the old partners will sacrifice their profit. So in case of admission of partner, there will be sacrifice ratio. Old ratio, new ratio and sacrifice ratio. Now in case of retirement of a partner, for example, P, Q and R are old partners. Old ratio is 2 is to 1 is to 1 and Mr. R is retiring from the business. Then new partners will be P and Q. So new ratio will be 2 is to 1. Old partners are P, Q, R. After reconstitution, that is at the time of retirement of Mr. R, new partners will be remaining partners, Mr. P and Mr. Q. Old ratio is 2 is to 1 is to 1. New ratio is 2 is to 1 because R is retiring now. His part of profit will be distributed among remaining partners. For example, if profit of a partnership firm is 12,000 rupees, It will be distributed among PQR in the share of in the ratio of 2 is to 1 is to 1. So while calculating the profit of Mr. P, we have to multiply the profit with its share. That is 12,000 rupees total profit of a business multiply by the ratio of Mr. P multiply by 2 divided by total of the ratio, that is 2 plus 1 4. So total profit of business 12,000 multiplied by 2 the share of partner P divided by total of profit sharing ratio. So 2 plus 1 4. 12,000 into 2 divided by 4, 6,000 rupees for Mr. P. Q and R are getting half of profit of Mr. P. So 3,000 rupees for Q and R. 12,000 rupees was distributed among PQR in the share of 6,000, 3,000, 3,000. Now after retirement of Mr. R, new profit sharing ratio is 2 is to 1. Then if the profit of partnership firm is 12,000 rupees, then it will be distributed among P and Q in the share of 2 is to 1. So new ratio of Mr. P will be 12,000 rupees multiplied by 2 divided by total of ratio is 2 plus 1 3 divided by 3. So the amount will be 8,000 rupees. Q is getting half of Mr. P. So new profit sharing ratio is 2 is to 1, and now profit will be distributed by 8,000 and 4,000. Now the remaining profit of Mr. R is distributed among P and Q in the ratio of 2 is to 1. So Mr. P is getting 2,000 rupees extra and Mr. Q is getting 4,000 rupees. Now profit of Mr. R is distributed among P and Q in gaining ratio, because after retirement of Mr. R, the profit is now distributed among P and Q, the remaining partners. So they are getting additional profit which belongs to Mr. R. So 3,000 rupees is distributed among P and Q. Now profit of Mr. P has been increased by 2,000 rupees and Mr. Q is increased by 1,000 rupees. So profit gaining ratio is 2 is to 1. The formula for gaining ratio is gaining ratio equals to new ratio minus old ratio. Sacrifice ratio equals to old ratio minus new ratio. Gaining ratio equals to new ratio minus old ratio. Here, at the time of retirement and death, we will get gaining ratio because partners, one of the partner is either retiring or in the case of deceased, the remaining partners will share the profit of retiring or deceased partner. So we will get sacrifice ratio in case of admission of a new partner. We will get gaining ratio in case of retirement or death. Now, at the time of admission of a partner, admission of a new partner, the incoming partner brings capital and a part of goodwill into the business And at the time of retirement of a partner, the retiring partner will take away his part of capital, which he has invested at the time of beginning of the firm, along with profit or loss, his part of profit and loss, or his share of profit and loss till the date of retirement. So it is a realized profit and loss. If the profit and loss is unrealized, then it will show in reserve and surplus. If previous year profit has been reinvested into the business, then it will show in reserve and surplus. So retiring partner will take away that part of profit also. So at the time of admission, new partner will bring capital and his part of goodwill. At the time of retirement, the retiring partner, the outgoing partner, will take away capital which he has invested, his share of profit or loss till the date of retirement. And if the profits are adjusted into reserve and surplus, then he will take away that amount also. Even in case of death of a partner, the legal heir, that is the nominee of the deceased partner, will take away the deceased partner's share of capital as well as profit and reserve and surplus. Now let's start with the illustration. Calculation of new ratio. Mohan and Ganpat are sharing profit and losses in the ratio 2:3. Mohan and Ganpat are partners. They share profit and loss in the ratio 2:3. So old ratio is 2:3. They admitted Chandrakant. Now Chandrakant is an incoming partner. This is the case of admission. They admitted Chandrakant for 1/4 share in future profit. Chandrakant will share 1/4 of total profit. The new profit sharing ratio of Mohan, Ganpat and Chandrakant will be, now to calculate new ratio, we have to deduct the share of incoming partner from 1. So 1 minus the share of incoming partner is 1/4. So the balance will be 3/4. The formula is 1 minus share of incoming partner. So we are getting 3/4. Now to calculate new ratio, we have to multiply old ratio with 3/4, the balancing part, that is 1 minus 1/4. So we will get 3/4. Now to calculate Mohan's ratio, Mohan's share of profit, we have to multiply old ratio, that is 2/5 with 3/4. We have to multiply 4 with denominator of old ratio and here 5. So we will get 2 into 3, 6 divided by 5 into 4, 20. So Mohan's share is 6/20. Similarly, we will calculate the Ganpat's share of profit by multiplying old ratio with 3/4. His share is 3/5. This is the case of Ganpat. 3 by 5 multiplied by 3 by 4. Now 3 into 3, 9 divided by 20. So this is the ratio. This is the ratio of Mohan, and 9 by 20 is the ratio of Ganpat. And now remaining partner belongs to Chandrakant. Now Chandrakant share will be balancing figure, that is 20 minus 6 and 9. So we will get 5 by 20. So new ratio will be 6 is to 9 is to 5. For Mohan, Ganpat and Chandrakant, new share will be 6 is to 9 is to 5. Now calculation of sacrifice ratio. A and B are partners sharing profits in the ratio of 6 is to 4. A and B are partners, old partners. They share profit and loss in the ratio of 6 is to 4. So old ratio is 6 is to 4. C is admitted as a partner. Mr. C is admitted. The new profit sharing ratio of ABC is 10 is to 6 is to 4. New ratio is also given, 10 is to 6 is to 4. Find out the sacrificing ratio. So we know that sacrifice ratio is equal to old ratio minus new ratio. So sacrifice ratio of Mr. A will be, old ratio is 6 divided by 10 minus new ratio is 10 divided by 20. Now to get same denominator, we have to multiply this by 2 and this by 1. So 6 multiplied by 2, 12 minus 10 divided by 20. 2 by 20, and sacrifice ratio B is old ratio 4 by 10 minus new ratio 6 by 20. 4 into 2, 8 minus 6 into 1, 6 divided by 20, 2 by 20. So sacrifice ratio is equal 2 is to 2, that is 1 is to 1. So sacrifice ratio is 1 is to 1 for Mr. A and B. Calculation of new ratio and sacrifice ratio. Praveen and Naveen are partners sharing profit in the ratio 7 is to 3. Praveen and Naveen are old partners and old ratio is 7 is to 3. They admit Reena. Reena is incoming partner. They admit Reena for 1/5 share of profit, which she takes equally from Praveen and Naveen. She takes equally from Praveen and Naveen. We have got sacrifice ratio, that is equal. Calculate sacrifice ratio and new profit sharing ratio. To calculate new profit sharing ratio, we already know the formula of sacrifice ratio, that is old ratio minus new ratio. So new ratio will be equal to old ratio minus sacrifice ratio. To calculate new ratio of Praveen, we have old ratio, that is 7 by 10 minus sacrifice ratio, that is 1 by 2. We have to multiply this by 1 and this by 5 to get equal denominator. So 7 minus 1 divided by 10 will be 6 by 10. Now we will calculate new ratio of Naveen equals to 3 by 10 old ratio 3 by 10 minus sacrifice ratio 1 by 2. So 3 minus 1 divided by 10 will be equal to 2 by 10. And now Rina's share will be balancing amount, that is 10 minus 6 and 2. So balance will be 2 by 10. This is the share of Rina. So profit sharing ratio, new profit sharing ratio will be 6 is to 2 is to 2. 6 is to 2 is to 2, that is 3 is to 1 is to 1. New profit sharing ratio is 3 is to 1 is to 1 and sacrifice ratio is 1 is to 1. Now calculation of new ratio and sacrifice ratio. X and Y are partners sharing profit in the ratio 7 is to 3. X and Y are old partners and old ratio is 7 is to 3. X surrenders, now it is talking about sacrifice. X surrenders 1/7 of his share. Sacrifice ratio is old ratio into 1/7 for X, and Y surrenders 1/3 of his share in favor of Z. And sacrifice ratio for Y is old ratio multiplied by 1/3. Calculate new ratio and sacrifice ratio. For X, old ratio is 7 by 10. 7 plus 3 is 10. So 7 by 10 multiplied by 1 by 7. And for Y, old ratio is 3 by 10 multiplied by 1 by 3. 7 will get cancelled and ratio will be 1 by 10 for Mr. X. Here 3 will get cancelled and 1 by 10 will be ratio. So sacrifice ratio is 1 by 10, 1 by 10. That is equal. Sacrifice ratio is 1 is to 1. Now by applying sacrifice ratio, we will get new ratio. Here sacrifice ratio is 1 is to 1. Now sacrifice ratio is equal to old ratio minus new ratio. So new ratio will be equal to old ratio minus sacrifice ratio. First we will calculate the new ratio of Mr. X. Old ratio is 7 by 10 minus sacrifice ratio is 1 by 2. Six by 10 for Mr. X. Y. Old ratio is 3 by 10 minus sacrifice ratio is 1 by 2. Two by 10. The new ratio of X and Y is 6 is to 2 and balancing will be of Z, that is 2. 6 is to 2 is to 2, that is 3 is to 1 is to 1 will be new ratio. Now let's start with the methods of valuation of goodwill. There are 4 major methods of valuation: average profit method, super profit method, annuity method, and capitalization method. Average profit means we have to sum up the profit of total years divided by number of years We can also give weightage to the profit. In case of super profit, we have to deduct the average profit with normal profit. How much additional profit a business organization has earned as compared to his competitors is called as super profit. So super profit is equal to normal profit minus average profit, that is additional profit. Annuity method. Under annuity method, we have to provide discounting factor to each year's profit to get goodwill. Under super profit method, the limitation is we do not provide time value to the profit. But under annuity method, we give discounting factor. We provide discounting factor to each year profit. Let's calculate goodwill by each method. First is average profit method. Profit and loss for past 4 years are given: 2016, 17, 18, 19. The amount of profit and loss are given: 1,20,000 for first year, 80,000 for second year, 20,000 loss for third year, and 60,000 profit for fourth year. So we have to sum up the profit and loss of each year, and we will divide by number of years. So 1,20,000 plus 80,000 minus 20,000 plus 60,000 divided by number of years, 4 years. So total will be 1,20,000 plus 80, 2 lakh, minus 20,000, 1,80,000 plus 60,000. 2,40,000 divided by 4 years. So 2,40,000 divided by 4. 60,000 will be average profit. So the amount of goodwill will be 60,000 rupees as per average profit method. If number of years purchased are given, then we have to multiply with number of years purchased. For example, if number of years purchased is 3 years, then 60,000 multiplied by 3 equals to 1,80,000. But if no additional information is given, then average profit will be equal to goodwill. Now let's calculate goodwill by super profit method. Find the value of goodwill from the following information by using super profit method. Years, 5 years are given: 2014, 15, 16, 17 and 18. Profit and loss information are given: 80,000, 95,000, 1,10,000 profit, 40,000 loss and 85,000 profit. This will be helpful to calculate average profit. Capital employed is rupees 3,50,000. Normal rate of return is 12%. This will be helpful to calculate normal profit. Goodwill is to be valued at 2 years purchased of super profit. Formula of super profit is average profit minus normal profit. First we will calculate average profit by using these details. Then we will calculate normal profit by using these details. So we will get super profit, and then we will multiply with number of years purchased to get the amount of goodwill. Now first we will calculate average profit. It is equal to summation of all profit and loss divided by number of years. So summation of all profit and loss, 80,000 plus 95,000 plus 1,10,000 minus 40,000 plus 85,000 divided by number of years are 5 years. So total 80,000 plus 95,000 plus 1,10,000 minus 40,000 plus 85,000. Total is 3,30,000 divided by 5 years. 3,30,000 divided by 5 years is 66,000. So average profit is 66,000. Now we will calculate normal profit by multiplying capital employed with normal rate of return. Average profit is 66,000. Second, normal profit is equal to capital employed, that is total investment, multiplied by normal rate of return. So capital employed is 3,50,000 and normal rate of return is 12%. So normal profit is equal to 3,50,000 into 12%, 42,000. Average profit is 66,000. Normal profit is 42,000. So super profit is equal to average profit minus normal profit, that is 66,000 minus 42,000 equal to 24,000. Super profit is 24,000. Now goodwill is to be valued at 2 years purchase. So we have to multiply super profit with number of years purchased. So last point, goodwill equals to super profit multiplied by number of years purchased, that is 24,000 super profit multiplied by 2 years purchased. So amount will be 48,000 rupees. The amount of goodwill under super profit method is 48,000 rupees. First we have to calculate average profit, and formula for average profit is summation of total profit and loss divided by number of years. We will get average profit. Then we will calculate normal profit. The formula is capital invested or capital employed multiplied by normal rate of return. So we will get normal profit. The difference between average profit and normal profit is super profit, and the amount of goodwill will be equal to super profit multiplied by number of years purchased. In the question we have given 2 years purchased, so 24,000 multiplied by 2 years, 48,000 rupees is the amount of goodwill. Now annuity method. We have discussed about average profit method. and super profit method. In both the cases, they have not considered time value of money. But in annuity method, we have to multiply the time value, that is discounting factor, with super profit. So under annuity method, the amount of goodwill will be equal to super profit multiplied by discounting factor, that is the time value. And time value will be given in the question. For example, number of years are given 1, 2, 3, 4, 5. Super profits are given 3000 for each year. Discounted factor at the rate 15% is given. So we have to multiply super profit with discounting factor to get discounted value of super profit. Then total of discounted value of super profit will be equal to goodwill. So number of years and super profit amount is given. We have to calculate discounted factor first. Discounted factor is 15%. So now to get discounted factor at the rate 15% for each year, on the calculator we have to calculate 1 divided by 1 plus discounted factor, that is 15%, 0.15, that is 1 divided by 1.15 for the first year. And then onwards, by clicking on equal sign, we will get discounted factor for another year. For example, discounted factor is 15%, so 1 divided by 1.15 for the first year, discounted factor will be 0.8695. 0.8695. Next, 0.7561. Next, 0.6575. Next, 0.5717. And next, 0.4971. Now we have got discounted factor for each year. Now we will multiply super profit with discounted factor. We will get discounted value of super profit. So 3 multiplied by 0.8695, 3000 multiplied by 0.8695, we will get 2608.5, 2608.5. Then 3000 into 0.7561, 2268.3, 3000 into 6575, 3000 into 0.6575, 1972.5, 3000 into 0.5717, 1715.1 and 3000 into 0.4971 1491.3. Now total of discounted value is equal to 2608.5 plus 2268.3 plus 1972.5 plus 1715.1 plus 1491.3. Total is 10,055 rupees and 70 paisa. 10,055.7. So this is the value of goodwill by annuity method. So under annuity method, we have given number of years and super profit for each year. We are also given the discounted factor, that is 15%. If there is 15%, so we have to calculate 1 divided by 1.15. And when we press equal sign, we will get discounted factor for first year. Click equal sign one more time, we will get discounted factor for another year. And likewise, if discounting factor is 10%, then we have to calculate as 1 divided by 1.10. By clicking on equal sign, we will get discounted factor for first year. Then again equal sign, we will get discounted factor for another year, second year. And likewise, if discounted factor is 9%, then 1 divided by 1.09, we will get discounted factor for first year. Again click on equal sign, we will get discounted factor for second year, and likewise. So the method of calculation of goodwill under annuity method depends on the type of question. Let's calculate the valuation of goodwill under annuity method by using different formula. Calculate the goodwill by annuity method of super profit. Annual maintainable profit after tax is given 65,000 rupees. This is nothing but average profit. Annual maintainable profit after tax is average profit. Capital employed is given. This is total investment into the business. Normal rate of return is 12% per annum. By multiplying NRR with capital employed, we will get normal profit. After deducting average profit with normal profit, we will get super profit. Present value of annuity for 5 years at rate 12% interest is given. So we will multiply super profit with present value. We will get annuity amount of goodwill. Let's start. Annual profit is 65,000. This is average profit. And normal profit will be 4 lakh into 12%. Valuation of goodwill by using annuity method. First step, average profit given 65,000 rupees less normal profit. The formula is capital employed multiplied by normal rate of return. Capital employed is 4 lakh multiplied by normal rate of return is 12%. 4 lakh into 12%, 48,000 rupees. The balance will be super profit 65,000 minus 48,000. 65,000 minus 48,000, 17,000 rupees. Now present value is given 3.604776. 3.604776. Now we will multiply 17,000 rupees, that is super profit, with present value 3.604776 to get the valuation of goodwill under annuity method, because we have considered time value of money. Now 17,000 multiplied by 3.604776, we will get 61,281.192. 0.192. This is the amount of goodwill under annuity method. Now let's calculate goodwill under capitalization method. Capital invested is given. This is net assets. Average profit of last 4 years are given 60,000 rupees. Normal rate of return is given 12%. By dividing average profit with normal rate of return, we will get valuation of firm. And then we will deduct net asset from valuation of firm to get amount of goodwill. So goodwill will be equal to valuation of firm minus net asset, that is capital employed. So average profit for last 4 years are 60,000 divided by normal rate of return is 12%. So 60,000 divided by 12% will be 5 lakh rupees. Valuation of firm is 5 lakh minus net asset is 4 lakh 10,000. The balance amount will be goodwill, 90,000 rupees goodwill. Next, find out the value of goodwill by various methods, that is average profit, super profit, annuity method, and capitalization method. Number of years are given and profit of each year is given. Capital invested and normal rate of return is given. Number of years purchased is given. So first we will calculate goodwill under average profit method. We will also provide weightage to average profit. So let's start. First, valuation of goodwill by average profit method. Number of years are given. Profit amount is given. We will give weightage 1, 2, 3, 4. Total weight will be 1 plus 2 plus 3 plus 4, that is 10. Now we will multiply profit with weightage. So weightage profit will be 1,20,000 into 1, 1,20,000, 1,25,000 into 2, 2,50,000, 1,30,000 into 3, 3,90,000, 1,50,000 into 4, 6 lakh. Total of weighted average profit is total of weighted profit is 1,20,000 plus 2,50,000 plus 3,90,000 plus 6 lakh. 13,60,000, 13,60,000 rupees is total weighted profit. We will divide weighted profit with total of weightage to get average profit. So 13,60,000 rupees divided by 10, 1,36,000 rupees. Now we will multiply the weighted average profit with number of years purchased, that is 3 years. Four lakh 8,000 rupees. 4,08,000 rupees is the amount of goodwill. Now let's calculate goodwill under super profit method. Capital invested 5 lakh rupees. We have average profit of 1,36,000 rupees less normal profit. The formula for normal profit is capital employed into normal rate of return. Capital employed is 5 lakh and normal rate of return is 20%. So normal profit will be 1 lakh rupees. Average profit less normal profit, super profit is 36,000 rupees multiply by number of years purchased, that is 3. 1,08,000 rupees. 1,08,000 rupees is the amount of goodwill under super profit method. Now we will calculate goodwill under annuity method. Normal rate of return is 20%. We will assume that the interest rate is 20% and goodwill is calculated for 3 years. So super profit multiply by discounted factor at rate 20%, that is normal rate of return. We have assumed that discounted factor is same as normal return. Then number of years purchased is 3 years. So we will calculate discounted factor for 3 years at the rate 20%. So 1 divided by 1.2 equal to 0.833 plus 0.6944 plus 0.5787. 0.8333 plus 0.6944 plus 0.5787. 2.1064 is 2.1064 2.1064 is discounted factor. Super profit is 36,000 rupees. 36,000 multiplied by 2.1064. 36,000 into 2.1064 is the amount of goodwill. Capitalization method. So first step is average profit, or rather we say weighted average profit, divided by normal rate of return. Average profit is 1,36,000 divided by 20 into 100. We will get 6,80,000 rupees. Valuation of business 6,80,000 rupees. Capital invested is 5 lakh. ₹1,80,000 will be the amount of goodwill. So under capitalization method, first we have to calculate valuation of business. Valuation of business is equal to weighted average profit divided by normal rate of return into 100 less capital invested or capital employed. We will get valuation of goodwill. Capitalization method. Under capitalization method, the valuation of goodwill is 1,80,000 rupees.